Okay, so hello my dear future chartered accountants. Moving on with respect to the next topic, that is branch accounts. Okay, so what are the things to be learned in branch accounts? Basic concept what you need to understand is a branch means a part of the organization situated elsewhere. So there is one definitely a head office and there is one branch. Various kinds of things can happen, but typically head office will send the goods. Typically telling you from exam point of view to the branch, and the branch will send it or will sell it to customers. Of course, they can also purchase from outsiders. They can also do purchases from outsiders, but they sell it to customers. And head office also will send cash for expenses like office expenses, salary expenses, etc., marketing expenses, and branch will spend expenses, spend cash. Branch will spend cash for expenses. And the money collected from customer and the whatever the money cash balance what you have, net balance, sometimes on a periodical basis they will send it back to head office. Cash disbursement. This is a typical set of transactions that you need to be aware of. Now, who will do the accounting? How it will take place? We have domestic branches, foreign branches. Domestic branches which are within India. You have independent branches, dependent branches. Independent branch means branch itself will maintain their own books of accounts and they prepare trial balance. At the end of the year they send the trial balance for consolidation. Head office with its trial balance, the branch trial balance will be sent out, merged, and financial statements are prepared. So in the independent branch system, branch will maintain their own books of accounts and they send the trial balance at the end of every year for the purpose of preparing final accounts. Dependent branches means head office will maintain the accounts relating to branch transactions also. Branch maintains on a single entry basis, that is not considered for finalization. Head office will maintain its own transactions as well as the transactions related to the branch. Under that, we have two methods. One is debtors method, other is stock and debtors method. Debtors method means we prepare only one. Debtors method means the head office will maintain the branch account they treat like a debtor. Branch is treated like a debtor. Treated like debtor. So opening balances of stock will come on debit side like a trading account, stock, debtors, cash. Any goods sent, debit the receiver, credit the goods sent. So branch account debit to goods sent. Then stock reserve will come to it later. Any goods reversed return will be credited returns, and any goods sent to branch, if you had any profit element they called as loading, so selling price will come here, goods sent, and debit side you will have a profit element, so sales minus profit, ultimately it will reflect in purchases. Cash sent will be to cash to bank. Money paid by the head office for the branch will be to bank because head office money spent. Cash received from a branch will be by cash remitted to head office. Closing balances will come on opposite side, by balance carried down, cash closing balance, debtors closing balance, petty cash closing balance. And on stock, even stock also will be there, I missed it. Closing stock also will be there. On closing stock, if they're valued at selling price, invoice price, profit element to be eliminated, that is called as stock reserve. It will come on the opposite side. Similarly, in the opening stock, if they're valued at cost, no problem. If they're valued on invoice basis, selling price basis, profit should be eliminated so as to reflect the stock at cost basis. A stock reserve is created. Opening stock is on debit side, so stock reserve is on the credit side. This is branch account. So where did bad debt come? Bad debt not accounted specifically, discount not accounted specifically, in the sense transactions between head office and branch, or transaction between head office and some other transactions accounted. Transaction between branch and its customer, branch when they make the payment, it is not accounted. How it is going to make sense? Definitely it's going to make sense. For example, you take a look at this. You have let's say paid, you have transferred the money, petty cash, you transfer the money to the branch. So you write to bank 10,000. They spent 9,000 rupees. Closing balance cash will be 1,000. So you see, opening 10,000, closing 1,000, net effect 9,000 rupees is automatically accounted. So expenses spent by head office on behalf of branch is accounted to bank, but expenses spent by the branch out of the cash balance is not accounted. So transactions between head office and branch is accounted. Transaction between branch and outsiders, like collected from customers, spent to salaries and all, not accounted. Depreciation also, opening balance we write it, closing balance we write on credit side, and on debit side we write any purchases. So balancing figure will automatically take care of any depreciation. Hopefully it's fine. So this is debtors method. Now stock and debtors method, we maintain every account. We maintain branch stock account, we maintain branch debtors account, we maintain branch trading account. So all accounts are on behalf of the branch is maintained by head office. So how do you differentiate between your debtors, that is head office debtors, and branch debtors? So we call our debtors as debtors, head office debtors, direct debtors as debtors, and debtors of branch account as branch debtors. So both of these methods we'll understand with the help of this problem. So come to this problem. Buckingham Brothers have a branch at Nagpur. However, direct purchases are also made by the branch, for which payments are made at head office. All the daily collections are transferred from the branch to the head office. From the following, prepare Nagpur branch in the books of head office by debtors method, also under stock and debtors method. Opening balance, impressed cash, sundry debtors, stock transferred from head office, direct purchases, cash sales, credit sales, direct purchases, return from customers, goods sent to branch from head office, transferred from head office for petty cash expense, bad debts, discount to customers, remittance to head office, received by head office only 1,65,000 and remittance to head office is 5,000, not received by head office so far, cash in transit. Branch expenses directly paid by head office 30,000, closing balances, the stock out of direct purchase, out of transfer from debtors, impressed cash. So transfer is happening at cost, so no need to worry about any loading, no need to worry about any stock reserve. Impressed cash closing balance, debtors closing balance we need to calculate. Okay, so first we'll solve under debtors methods. Okay, so we'll prepare under debtor method in the books of head office, branch account. This is a combination of branch trading account as well as branch debtors account. So branch accounts. Okay. So debit side, opening balance. Let's write down the quick format. To balance brought down, all opening balances. By balance carried down, all closing balances. So we will have cash, impressed cash, stock, debtors. If we have like furniture, fixed assets also you can write. Closing balance on opposite side, cash, stock, debtors. A typical opening balance, closing balance. Okay, what are the information given? Opening balance impressed 2000, opening balance 2000. Stock transferred from head office 24, direct purchase 16. Write the total number 24 plus 16, 40,000. It makes no difference whether the stock is from the head office or the stock is from the direct purchases made. It does make a difference if goods are sent at cost plus profit. Loading is involved because when goods received from head office will have the loading, branch will not know, head office will know. This is prepared in the books of head office. So if the stock was out of goods transferred from head office to branch, that will include a loading element. But if the stock is out of direct purchases, that will not have any loading element. No need to create any stock reserve on stock which is out of direct purchases. But in this problem, it is sent at cost. We don't have any invoice price information, so you don't have to worry about any stock reserve. Total stock we can write. Debtors, total debtors, opening balance 25,000. Opening balance 25,000. Hope that is clear. Then direct purchase, okay, cash sales. Now cash sales is made by the head office to branch or branch to outsiders. Branch has sold the goods to customer and it has collected money from customer. So 45,000 will not come here directly because it is cash collected by the branch from the customer. Head office is not involved. If head office is not involved, that transaction don't come in branch account. Be it discount, be it bad debts, or be it depreciation, any of that matter, where the head office is not involved, transaction don't come. Head office and branch transactions will come, cash and goods and cash received, good received. But here branch and customer, money collected from customer, cash sales, money paid to the employees of the branch, discount given, the bad debts happening. So transaction between branch and outsiders, what you have will not be given effect in branch account. I repeat the thumb rule. Transactions where head office involved, the transactions will come in branch account. If head office is not involved, that is where branch and outside party, third party transactions takes place, that portion is ignored. Hope you are clear. That is cash sales will not come, credit sales will not come, direct purchases, payments are made at head office, so head office involved, so we write to bank 45,000. This is for the direct purchases. Return from customers will not come. Goods sent to branch from head office will come 60,000. Because head office involved. To goods sent 60,000. Transfer from head office will come to cash because head office is involved 4,000. Bad debts will not come, discount to customers will not come, remittances to head office received and not received, both will come because head office involved. So by cash remittance One is receipt, other in transit, both will come. Received is 5,000, 1,65,000. In transit is 5,000. Branch expenses directly paid by head office involved, it will come 30,000. To cash or to bank, direct expenses 30,000. Closing stock 10,000 out of direct purchases, 15,000 out of transfer from head office, but does not matter, both are closing stock only. So 10 plus 15, 25,000. 25,000. Okay, now debtors we don't know, we have to calculate. Cash, impress system means opening balance and closing balance both will be same, so 2,000 each. Only for debtors we'll do a working note. Let's say memorandum debtors account, only to find out the closing balance. You know typical format of debtors accounts: opening balance, to balance brought down, opening, by balance carried down will be closing. Any sales happened, to sales, credit sales, then credit sales, then by discount if you have given, by bad debts if you have any bad debts, by sales returns if there are returns from customers, by cash, money collected from customers. Opening balance of debtors we know 25,000. Credit sales we have 1,30,000. Discount to customer 2,000, bad debts 1,000. Discount 2,000, bad debts 1,000. Sales returns, anything is there? Goods sent to branch transferred, okay. I think no. Sales returns we have returns from customer 3,000. 3,000. Now cash collected directly not given, indirectly given. Where is indirectly given? Once you receive the money from customer, you deposit to the head office. How much you received? You transferring 1,65,000 plus 5. So 1,70,000 should be with you. Out of 1,70,000, 45,000 is out of cash sales. Remaining cash, where did you got it from? From your collection from customers. So 1,65,000 plus 5,000 minus 45,000, that will give you 1,25,000. 1,25,000. Balancing figure you calculate 25 plus 1,30,000 minus 2,000 minus 1,000 minus 3,000 minus 1,25,000. Balancing figure will get you 24,000. So total 1,55,000 and balancing figure you get 24,000. That you can write in the balance sheet, in the branch account. 24,000 debtors, 24,000, and find out balancing figure, whatever it is, transferred to P&L account, to P&L, that is profit from branch. Find out the balancing figure. One lakh 65 plus 5 minus 2 minus 25 minus 24 minus 2 minus 40 minus 25 minus 45 minus 60 minus 4 minus 30. 15,000, right? Yeah, 15,000 profit and loss transferred to branch, 15,000. So this is under debtor system. Debtor system, where branch is treated like a debtors. Transaction between head office and branch is accounted. Transaction between head office and outsiders related to branch is accounted, but transaction between the branch and the outsiders is not accounted. Hope it is fine. Now I'll go to stock and debtors methods. Stock and debtors method. We prepare branch stock account. You can also say branch trading account, branch debtors account, branch cash, branch expenses, branch adjustment, or I can say branch P&L. For everything you had the word branch, 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 branch. Okay, so branch stock opening balance, branch debtors opening balance, branch cash opening balance. Okay, so you write down till here, then we'll account for every transactions one by one. You write down till here. Okay, okay. Now for every transactions, you will have to do a double entry system. What do you mean by that? Opening balance of cash is done, debtor is done, stock is done. Direct purchases. Direct purchases, this is stock. Okay. Cash sales will come in the, what is journal entry for cash sales? Cash account debit to sales account. So branch cash account debit to branch sales. We don't say branch sales, we will say branch trading account. You can also say branch stock account. So cash sales, you see, trading account you write buy sales, and this corresponding entry you write. The entry is like cash account debit to sales. You don't say cash, you say branch cash. You don't say sales, you say branch stock. Stock is going out, branch stock, cash sales. Credit sales. Credit sales will be what? Credit sale. Normal entry for credit sales. Debtor account debit to sales account. We don't say debtors. We say branch debtors. We don't say sales. Again we say branch stock account. So to branch stock 1,30,000 by branch debtors 1,30,000. Write down. Okay, next, direct purchases, that is branch stock to bank, and we don't write in branch cash buy thing because its amount is paid by head office. It will go from their bank account. So you only write to bank. Direct purchases. Direct purchase. This is will go from head office bank account. These are all branch account. So only thing which will come is branch stock account debit to bank. Bank, it will be related to head office, for which we are not preparing any ledger accounts. So only one entry will come to bank. Okay, next. Returns from customers, 3000. What is the journal entry for returns? Normally we say sales returns account debit to debtor account, right? We don't say debtor account, we say branch debtors. We don't do sales returns, we do branch stock. So branch stock account to debtors 3000, and in the branch debtors by branch stock 3000. These two related to sales returns. Sales returns, write down. Okay, next. Goods sent to head office, goods sent from head office to branch to goods sent. It will be adjusted from purchases in the head office account. That you don't worry. You write only to goods sent 60,000. Okay. Now, cash sent from head office to branch cash to cash 4,000. What is this entry, sir? Cash to cash. From head office cash, which is just a cash account, you're transferring it to branch cash. So like right pocket to left pocket. Right pocket, let's say cash account. Left pocket, let's say branch cash account. So branch cash account receiving and going out from right pocket. So left pocket to right pocket, branch cash account debit to cash account. And impress system means how much cash will be transferred only to the extent of money spent by you. So this 4,000 would mean you have spent this money. So by branch expenses 4,000, and in the branch expenses to branch cash 4,000. Money spent. By branch expense 4,000 to branch cash 4,000. Okay, next. Bad debts in the branch debtors account by bad debts, and bad debts will be transferred to the branch P&L account. Similarly, by discount and will be transferred to the branch P&L account to discount. So transactions between the debtor and the customer everywhere in the debtors method we ignore, and here we provide double entry effect. transactions between branch and outsiders, we are going to give double entry effect, that is stock and debtor system. And money collected from customers, that is once you collect the money from customer, you pay to the head office. How much you paid? Cash you paid 1,65,000, 5,000 is in transit. So by cash, transfer to head office and received by head office. Cash in transit 5,000, transferred to head office, but is still in transit. Still in transit. Okay, next. Money directly paid by the head office for branch expenses to cash 30,000. Directly paid to cash. To cash means head office cash. To cash. Then closing balance of the stock account, like in trading account you write, right? By closing stock, closing balance of stock. Closing balance of branch cash, impress system, same as opening balance, impress system. And branch debtors balancing figure, you can say 1,25,000, which you have calculated also, 1,65,000 plus 5 minus 45,000, which will ultimately come to 1,25,000. This is the money received from customer. So you write by branch cash 1,25,000, money received by branch from its customer, by branch cash 1,25,000. Balancing figure in debtors account 24,000 closing balance. And branch expenses transferred to branch P&L, or you can say branch adjustment account. You can also say transfer it to this balancing figure, like a gross profit, also transfer to branch adjustment account. So this is like gross profit in the trading account and branch adjustment, both of them are transferred to branch P&L account, branch adjustment account, branch P&L account. And balancing figure, you can see that's how you get 15,000 balancing figure in branch adjustment account, nothing but branch P&L, which is the exact amount we have got in the debtors method. So please take a look at this and write down the solutions. I'll give you 5 minutes. Please copy it down. See if you are able to understand all the adjustments. Okay, so hope you have taken down. So this is with respect to the dependent branches, debtors method and stock and debtors method. Now we'll go for independent branch. Now independent branch means what? Head office maintain its accounts and branch will maintain its accounts, and together we combine it and we prepare the consolidated P&L account and balance sheet. And we have to do a problem on foreign branches, and foreign branch also will come under independent branch only. So why don't we do a direct problem on foreign branch itself? Now let's look at the special points relating to the foreign branch. So first what we have to do is, they will give the foreign branch account in dollar terms, foreign currency terms. It should be converted into rupee terms. What are the conversion rate to be applied? I'll discuss with you now. The difference in the trial balance will be transferred to P&L account, or it will be transferred to FCTR account, foreign currency translation reserve. That is depending on the type of branch. I'll discuss it. They prepare P&L account together, consolidated and balance sheet only one column. Okay, what are the rules to be applied? It may be an integral foreign operation or non-integral foreign operation. What is integral, non-integral? We have already discussed during the AS11 stage. Let's look at the conversion rates. If it is integral operations, as if you are involved, so what transactions will be applicable to you? The same rate will be applicable for translating trial balance of integral foreign balance sheet, integral foreign trial balance into rupee terms. So monetary items like cash, debtors, bank balance, closing rate, non-monetary items like fixed asset stock, investments or date of purchase, historical rate, expense income, average rate, and difference is transferred to P&L account from the trial balance. For non-integral operations, where basically they are independent, everything at closing rate. Monetary item is also closing rate, non-monetary also closing rate. Conversion, that is average rate, is applicable for P&L account items for income and expenses, and difference is not transferred to P&L, difference is transferred to FCTR, foreign currency translation reserve. Okay, so and goods sent by head office to branch and head office account will not require any conversion. Why these don't require conversion? Because actual amounts available. Sir, what do you mean by that? Head office will have two goods sent and branch will have goods received from head office. That amount should match perfectly and should be set off also on consolidation. So goods sent by head office and whatever the goods received by the branch will be netted off straightforward, no conversion rate to be applied. Similarly, head office will have branch account, a branch will have head office account, like receivable, payable within organization, mutual owings should be set off, exactly to be set off. So for these two entries, conversion rates don't apply. ABC Limited has head office at Delhi and branch New York, USA. Is that the problem you have? No, it's not the problem you have. Sorry. Yeah, this is the problem you have. This problem you have. Yeah. ABC Limited Delhi has a branch in New York, USA, which is integral foreign operations of the company. At the end of 31st March 2013, the following ledger balances have been extracted from the books of Delhi office and New York branch. So you have a head office in rupee terms, New York branch in dollar thousands. The following information is available: stock, closing stock, Delhi, New York. Head office always sends the goods at branch at cost plus 25. Stock reserve would be required on closing stock and opening stock. Head office always send the goods to branch at cost plus 25. Provision to be made for doubtful debts 5%. Depreciation to be provided on building at 10%, and plant and machinery at 20% on written down values. You're required to convert the branch trial balance into rupees using the following exchange rate: opening, closing, average, fixed assets. Prepare Trading and P&L account for the year ending 31st March 13 show the extent possible head office results and branch results separately, means columnar format we prepare. So which account? Integral or non-integral? Which is an integral foreign operation. So transfer trial balance difference will be transferred to P&L, and non-monetary items will be valued at historical rate. If it was non-integral, non-monetary would be valued at closing rate. That's the only difference. Okay, so first we'll convert trial balance into rupees. Take a look at this. Don't write down. I'll give you time to write down. Plant and machinery. Okay, historical cost. What is plant and machinery? Plant and machinery, we are having 100. Historical cost for fixed assets 45. Accumulated depreciation also should be same only, because that is relevant for fixed assets. So plant and machinery historical cost for fixed assets. Plant and machinery depreciation reserve, accumulated depreciation, corresponding number only to be applied. Trade receivable payable, you take the average rate. See, this is specific rate, historical. This also historical. This is closing. Trade receivable and payable are monetary items. Stock, historical, non-monetary items. Opening balance. Opening, 50 rupees, opening. Cash and bank balance, closing, because monetary item. Purchase sales, average rate, because P&L account item. Income and expense, goods received from head office, actual, no rates. Wage and salaries, average. Rent, average. Office expenses, average. Commission receipts, income, average. Head office current account, no specific items, no specific, no conversion, specific items. And where do we get this 1500 and 800? I'll show you. Come back to the trial balance. Look at the trial balance. In the head office books, we have branch account 800, actual. Okay, then goods sent to branch, actual 1500. See, that's where we got 800 and 1500. Okay, so 800, 1500 are obtained from head office trial balance. Please write down till here. Then we go for the balancing figure. Please write down slowly. Okay, hope you have done. The difference now, exchange loss, because debit balance is less, credit balance is high, so debit balance balancing figure, exchange loss transferred to P&L because it is integral operation. If it was non-integral, you would have transferred to balance sheet under item called as FCTR. So write down the balancing figure. Okay, next. Trading P&L account, we'll do in a columnar manner. So opening stock, purchases, goods receipts and goods sent, two wages and salaries, balancing figure, gross profit. Let me tell you the amounts from the trial balance, what and all we take. Okay, so what and all goes to it, please identify. Share capital goes to balance sheet, reserves goes to balance sheet, land goes to balance sheet, building goes to balance sheet, building depreciation reserve goes to balance sheet, plant and machinery balance sheet, plant machinery depreciation reserve balance sheet, trade receivable balance sheet, stock, opening stock, this 250 and this 25 into that what we taken from trial balance will go to the trading account. Branch stock reserve will come in general P&L, I'll take it later. Cash and bank balance sheet, purchases sales by using average rates, we have done the trial balance already, will come in trading account. Managing director salary will come in general P&L. Wages and salaries, they said wages and salaries, you know, wages come to trading, salaries goes to P&L, but they said wages first. I thought wages is more dominant, so I'm taking in the trading account. Alternatively, you can take this account in P&L account also, completely fine. Rent will come in P&L, office expense will come in P&L, commission receipts will come in P&L, branch account anyway will not come. Goods sent to branch 1500 will be credit side for Delhi, that is for branch credit side, and goods received for the branch debit side same 1500, not 30, that the actual rate is taken same 1500. And closing stock $10, remember $10, and closing stock we take the historical rate, which is closing stock rate, which is 10 multiplied by 55, 10 multiplied by 55, 550, but don't take 550, this is rupees in thousands, so divide by 1000, you get only 0.55. That's what I've done here. This is calculated by 10 into 55, this is 550, but rupees in thousands, so divide by 1000, you get 0.55. Balancing figure, gross profit, and by gross profit brought down to rent, to office expenses, to provision of doubtful debt, they said 5% to be created, and by commission receipt. You write down till here, then we compute further. Write down till here. Okay. Now, depreciation, they said to be calculated. Let's calculate depreciation. Depreciation to be charged at 10% on buildings and plant and machinery 20% on returned on values. Please observe, returned on value means not on cost, cost minus depreciation. So look at machinery depreciation, building 1000, reserves 200, so WDV becomes 800. So depreciation on building, thousands minus 200 into 10%, which is 800 into 10% means 80. Then they ask depreciation on plant and machinery also. Depreciation on plant and machinery, 2000 minus 500, 1500 into 20%. 1500 into 20%, 300. This for head office. What about the branch? Branch is having plant and machinery 4500 minus 90. 4500 minus 90 into 20%. Sorry, 4500 900. 4500 minus 900 into 20%. 3600 into 20%, 720. So total 380 for head office, branch 720. 380, 720. Balancing figure, net profit transferred to general P&L. Then we prepare general P&L, or I'm writing in the total column. What and all will come? Exchange loss will come and stock reserve will come. Exchange loss, margin debtor salary also will come. Opening stock reserve, this is balance sheet given. Opening balance sheet given from opening trial balance, from trial balance. And closing stock reserve we have to create. What they said, goods will be sent from head office to branch at 20% on cost, but this is on sales, so 20% on cost means 20 by 20, sorry, cost plus 25%, 25% on cost. 25% on cost means on sales will become 25 by 125, and closing stock is 0.55. Entire stock is from head office only, so 0.55 into 25 by 125. 0.55 into 25 by 125. You get the net profit, and you can also prepare the balance sheet if you want. But they've asked for trading P&L account, which you have prepared. Please write down till here. Okay. They have not asked balance sheet. Still, I've quickly done balance sheet for our reference. I will show it to you. You need not take it down. You can just go through it for your reference. They have not asked in the question, but in case they have asked. So I'll show it to you the balance sheet portion now. Share capital. Again, I'm not writing in Schedule 3 format because this is just to tell you the concept of combining balance sheets. Share capital, reserves from the trial balance, P&L account of head office was there 940, and plus P&L what you prepared now. P&L what you prepared now 5870.44. Trade payables, head office plus branch. Head office will come trial balance. Branch trial balance we convert into rupees, that will come. Land no change. Building 1000 minus 800, 200, 800 was there, but minus depreciation, so again we did 80, so balance will come. Plant and machinery 2000 minus 500 is there, that is the cost minus depreciation, and further depreciation we did 300, net 1200. And head office is over. Branch 4500 minus 900, 3600, further depreciation 720, 2880, total 4080. Trade receivable sum 500 plus 3800, and minus they said provision some 5% they said provision. Stock 200, stock closing stock minus stock reserve, and cash and bank simply addition. So balance sheet is tallied. You need not take it down. I just given for your reference. If you want, you can quickly take it down. Okay, so this is the discussion about branch accounts. Okay, so hello my dear friends. Now moving on to the next one, we have to cover two chapters: redemption of preference shares and redemption of debentures. Redemption of preference share, I'll solve it with the help of a problem. Redemption of debentures, I will show you the whatever study material we have, and along with that I'll explain you the solution. Hope that is fine with you. Now come to this problem. Let's understand about redemption of preference shares. The summarized balance sheet of Clean Limited on 31st March 2019 is as follows: particulars rupees, share capital, reserves and surplus, trade payables total, plant property equipment, tangible assets, non-current investments, current assets, cash and cash equivalents. The share capital of the company consists of 50 each shares of 4,50,000. Is it so? 4,50,000, 50 each. Let's calculate. What do you get? 4,50,000 into 50. 2 crore 25 lakh. Okay. Rupees 50 each, shares of rupees 4,50,000. Okay, no, not 4,50,000 into 50. 4,50,000 is the amount. Number of shares, if you want to do 4,50,000 divided by 50, I think 9,000. Okay, anyway, 4,50,000 is the equity share capital, and preference shares 1,30,000. Preference share capital 1,30,000. This symbol rupees, I copy pasted the symbol. If it's printed in your material, that is 6 rupees. 4,50,000 plus 1,30,000, 5,80,000, which is what we have, 5,80,000. Reserves and surplus comprises of statement of profit and loss only. Very nice. In order to facilitate redemption of preference share at a premium of 10%, the company decided to sell an investment for 30,000. What is the investment value? 37,000. And what they're selling for? 30,000. So 7,000 loss. To finance redemption from company funds subject to leaving a bank balance of 24,000. To issue minimum number of shares of 50 each at a premium of 10 each to raise the balance of funds required. You're required to pass the journal entries to record the above transactions and prepare balance sheet after the above transactions. Okay. So before we discuss anything else, first let me tell you about the impact of redemption of preference share. Then we'll understand with respect to this problem. Okay. So redemption of preference shares. What is the meaning of redemption of preference share? Means payment of amount, whatever the payment to preference shareholders. Payment to preference shareholders. So what is the impact? Let us understand two types of impact. impact on liability side of balance sheet, and impact on asset side of balance sheet. To the extent of two parts will be there, to the extent of face value paid and over and above face value, in the sense premium paid over face value. Both will result in reduction of cash and bank balance. Reduction of cash and bank balance. And here also reduction of cash and bank balance. On liability sides, again to the extent of two parts, to the extent of face value, to the extent of premium, to the extent of face value, preference share capital comes down, and premium means your reserves will comes down, reserves reduces. Now we'll have one additional thing that is purely applicable for redemption of preference shares. When you repay bank loan and all, will not happen. That is additional adjustments. What is that? To the extent of face value, you need to have two choices. Either you issue fresh issue of equity shares, or you transfer to CRR. So additional reserves will reduce further if you transfer it to CRR. So premium, one part reduces. Additionally, you have to create CRR. That means if you do this CRR, your free reserves will reduce. Free reserves reduces. It will be in reserves, but it will be transferred to CRR. If you transfer to equity share capital, if you issue of shares, then CRR not required. But if you don't issue the shares or a balance amount, you require CRR. So the question said you have to issue minimum equity shares. You don't want to issue equity shares, but minimum you have to issue shares. So if you have sufficient reserve surplus, you can go ahead with that. One more thing, they want to leave a bank balance also. They want to leave a bank balance of 24,000. So write this chart, then we'll write the analysis of how many shares to be issued. Okay, hope you've done. Now let's go for the working note, then before the work, whatever the amount required. Okay, so let's calculate now. What is the amount of redemption payable? We require number of shares for that matter. Number of shares to be issued, and they said minimum. Because they said bank balance to be maintained, I'm thinking from minimum bank balance to be maintained. Okay, so amount required to be paid to preference shareholders. How much? Face value, then premium. How many shares to be redeemed? The company decided to redeem full preference share at a premium of 10%. So face value is 1,30,000. Premium 10%, that means 13,000. So total amount required is 1,43,000. That is the total amount required. Now, what is the source? Source to make payments? Existing bank balance. Existing bank balance. From the balance sheet you are having cash and cash equivalent, you are having 62,000, but they said you have to leave a minimum balance of 24,000, that you cannot touch it. Balance amount available 62,000 minus 24,000, that is 48,000 or 38,000. Yeah, 38,000. Then the sale of investment also took place. Sale of investments, they sold the investment for 30,000. So balancing figure from issue of a fresh issue of equity shares. Balancing figure 1,43,000 minus 38,000 minus 30,000. How much it comes to? 75,000. So 75,000 is the money to be raised by way of issue of equity shares. 75,000. And what is the issue price? Are you issuing it at face value? What they're telling? Issue at 50 each at a premium of 10 rupees. So issue price 50 plus 10, 60. So number of shares to be issued is 75,000 divided by 60. 1250. Okay, so with this what we took care of is related to the asset side of the balance sheet. Bank balance and all we considered. Asset side we took care. What about liability side? You have to transfer to CRR to the extent of face value if not issued by issue of equity shares. Let's understand that impact. Impact of redemption. Impact of redemption. We told you preferential capital will reduce. Preferential capital will become 0. Okay, let me just quickly tell you. On asset sides, bank balance will reduce by 1,43,000. On liability side, face value, this preference share capital will reduce by 1,30,000, which means preference share capital will become 0. Then premium or redemption 13,000 will, because of this, reserves reduces by 13,000. Then additional impact for face value. What is face value? 1,30,000 by issue of equity shares. Okay, reserves by issue of equity shares. What is happening? Additional impacts. Issue of equity shares. Equity share capital will increase by we are issuing 1,250 shares of 50 each. How much? 1250 into 50, 62,500. Then premium also is there. So premium created by, which can be used for redemption of preferences also actually. That is 1250 into 10 rupees. 12,500. So 13,000 we required. So 12,500 we can use this only. Instead of using other reserves, using security premium is better. Okay. Now CRR to be created out of reserves. How much? Face value of redemption 1,30,000. But equity share issue 6,500. Balance amount 1,30,000 minus 6,500. Balance amount should be transferred by way of CRR from free reserves. From reserves. 67,500. Okay, so write down till here. Now what we should do for all these things, we should give a impact. Okay. Okay. Now let's go to journal entry now one by one. Journal entries. Hope you have taken down this. Okay, anyway, just write down this. On asset side, bank balance will reduce by 1,43,000. On liability side, preference share capital will reduce by 1,30,000, which becomes 0. Premium redemption 13,000. So reserves will reduce by 13, which we can use it from issue of equity share premium also can be used. Additional impact because of the CRR by issue of shares, equity share capital 6,500. Premium created because of that 12,500. You know CRR to be created to the extent of face value of preference share capital redeemed except to the extent of shares issued. So redemption of preference share 1,30,000, 6,500 is by way of issue of equity shares. Balance 67,500 will require to be balance 67,500 required to be adjusted by way of transfer to CRR from free reserves. Please write down. Okay, let's go to journal entries now. Okay, so you have sold investment first. So sale of investments, bank account debit, you sold 30,000, but book value was from the balance sheet 37,000. So loss on sale of investment, which will basically means P&L, 7,000 to bank 37,000. Sale of investments. Then issue of equity shares. You can do two entry like bank account to share application allotment to equity share capital you can do, or you can write one entry also. Let's say I'll pass two entries. Bank account 75,000 to share application and allotments. $75,000. Then share application allotment will be debited. Share capital security premium will be credited. Share application and allotments 75,000. Debited to equity share capital 70 no, not 76 to 62,500, I think. No, 62,500 and 12,500 security premium to securities premium 12,500. Okay, now redemption of preference shares. Redemption of preference share due first. So preference share capital 1,30,000. Premium on redemption of preference shares 13,000 to bank 1,43,000. Let's adjust the premium amount by way of security premium first. Security premium 12,500, balance 500. I will take it from other reserves and surplus. P&L. Accumulated reserve 500 to, you can entirely transfer to P&L also, that's also fine, to premium on redemption of preference shares 13,000. Transfer to CRR we have to happen now, and you have to pay the to bank. Yeah, let's say do two preference shareholders. Let me pass one entry, two preference shareholders. Then let me pass an entry. Due entry one, payment entry another. Preference shareholders account debit 1,43,000 to bank. You can pass one entry also, that is also fine, like the way I transferred, like the way I passed. Then transfer to CRR, that is P&L, because they said reserves consist of P&L account only. We have calculated how much was the CRR, 67,500 to capital redemption reserve 67,500. Okay. Okay, let me just prepare two specific notes, share capital, reserves and surplus, then I'll go to balance sheet. Notes to accounts. Share capital. We had equity share capital. How much was there as per the adjustment, as per the information? We had 4,50,000. 4,50,000 plus now we have done the fresh issue. How much fresh issue we have done? 6,500 face value. So total 5,12,500. Preference share capital. We had 1,30,000, but entire amount is redeemed, so amount will become 0. Our closing balance also will become 0. I mean total. So net amount, if I write it, we get 5,12,500. Now coming to reserves and surplus, we had profit and loss accounts. As per balance sheet, how much is given? Because reserves surplus comprise of P&L account only, it comprises of 1,96,000. It comprises of 96,000. It comprises 96,000. It was given, balance given. Now what and all you have used it for? For premium on redemption. Entire amount we did not use. Look at the journal entry. We had to make use only of 500. Then transfer to CRRs. How much we transferred? 67,500. And also loss on issue, loss on sale of investment is there. Loss on sale of investments. 7,000. What is the net amount comes to? 96,000 minus 500 minus 67,500 minus 7,000, 21,000. Then we have CRR 67,500. So total amount 88,500. Total amount 88,500. Okay, so now let's prepare the balance sheets as per schedule 3 formats. Balance sheets, particulars, notes, amounts. We have equity and liabilities. First we have equity, shareholders funds. Then we have share capital. We have done note 1 also. How much was the amount? 5,12,500. Is the amount correct? Yeah, 5,12,500. Reserves and surplus. That also we have done the working note, 88,500. There's no non-current liabilities. We have current liabilities, which is only one thing we have, that is trade payable. That whatever previously was there, that continues, 1,13,000. So total balance sheet 7,14,000. Asset sides, non-current assets, we have PPE, that remains, no change, 6,90,000. Then current assets, investment is sold, it will not come. So cash and cash equivalent only, we have nothing else. Cash and cash equivalents. So we had how much? As per balance sheet, cash and cash equivalent, we had 62,000. 62,000. We sold investment for 30,000. We received equity shares by how much amount we received by way of equity shares? 30,000 we received here, 75,000 we received. And we paid 1,43,000. Actually, it should come to the balance we want to maintain, but anyway, we have shown the calculation. So 62 plus 30 plus 75 minus 1,43, 24,000. This is the balance we wanted to maintain. Total 7,14,000. Balance sheet is done. Okay, so this is regarding your redemption of preference shares. Okay, so now redemption of debentures. Redemption of debentures, I don't have a problem in my material I've given. So I'm discussing from the study material itself. So you can also use study material as a reference, and one problem I'll explain along with the study material problem. So redemption of debentures. Redemption of debenture beauty is you don't have a problem of redemption of preference shares like transfer to CRR, not required. But every year you have to transfer to DRR, debenture redemption reserves. Okay, who should transfer? Something and all is there. Like, what are the methods of redemption? By lump sum payment, pay it. By payment installments over a period of time, or purchase from open market. So you purchase debenture and then you cancel it. By conversion of into shares, debenture becomes shares, debenture is closed. So redemption of preference shares, fixed number, specific notice, or annual drawing and all is there. Debenture redemption reserve. What is this redemption reserve? Please try to keep the basics in mind. Let's say you want to buy a car and the car cost is 10 lakh. You don't want to buy it now. You want to buy it after 5 years. So every year in your salary, you have to keep the money aside and you accumulate, and then after 10 years, you make the payment and you purchase the car. That is what is debenture redemption reserve. Debenture redemption reserve means amount to be set aside every year by a company. Why should they keep it aside? Because after 10 years, after 15 years, when they have to pay the amount to debenture holders, huge sum, suddenly money will not come out of the air. Every year they have to keep the money aside so that when the time comes, they can redeem it easily. So the money kept aside out of profits every year is called as debenture redemption reserve. And who should create requirement? Who should create company issue debenture under this section? Rules are there. What balance to be maintained? They're all there. You can go through it. I don't want to talk about it. Like debenture to be issued by financial institutions, other financial institutions, listed companies, NBFCs. Rules are also there that you go through it. How much to be transferred, which type of company to be transferred and all. So investment or debenture redemption reserve amount. The best part is when you keep the money aside, journal entry will be P&L account debit to debenture reserve, debenture redemption reserve. And when you invest the money, it will be to bank, and debit will go to debenture redemption reserve investment account to bank. So on asset side also you have investment, liability also you have reserves like your JLP, like that. So when you break this, when you sell the investment, profit or loss will be transferred to P&L, debenture redemption reserve will be transferred to general reserve. In the sense, till when redemption takes place, redemption reserve also will be there. When you sell it, when you close it, when you redeem it, redemption reserve will be transferred to general reserve, thereby telling from that point onwards it becomes free reserves. And when you hold the investment, any income you generate on sale of investment, any profit or loss you get will be transferred to P&L account. In that sense, previously we had to maintain redemption reserve investment fund account, sinking fund account, nothing of that sort. Any profit or loss on sale of investment, any income we generate, everything is transferred to P&L. Very simple approach. Okay, so allotment of debenture journal entry, for setting aside amount of profit redemption, P&L account debit to debenture redemption reserve. I told you amount set aside every year. For investment setting aside, investment account debit to bank. So debenture redemption reserve, investment account to bank. So on asset side, we will have debenture redemption investment asset side. Liability side, we have redemption reserve account. One liability reserve, one asset. On sale of this, investment will be transferred to bank, profit or loss transferred to P&L, and debenture redemption reserve will be transferred to general reserve. It means it becomes free reserve. On receipt of interest, bank account debit to interest, and interest will be transferred to P&L. That's it. At the time of redemption of debentures, bank account to debenture redemption reserve investment is sold, and debentures to debenture holders, payable to debenture holders, and debenture holders to bank, any differential amount transferred to debenture redemption reserve to general reserve, and profit or loss investment will be there, also transferred to P&L account. In case the company purchases own debentures in the market, then cancels it, then also similar entry will be there. And if you want to know more specific about own debentures, refer group 1 accounting investments. That's what they're telling. Okay, so let me tell you a problem to help you understand own debentures also, cancellation of debentures also. So take a look at this problem. No need to write down, institute question only, no need to write down. Along with reading the question, I will explain it to you. Fine. So come to this problem. If possible, try to have material along with you. Okay, now on January 1st, Rama Limited, a listed company, had 500 debentures of 100 each outstanding in the books, carrying the interest of 6% per annum. In accordance with the regulatory requirements, the directors of the company acquired debentures from the open market for immediate cancellation as follows: March 1st, 5,098 come interest, August 1st, 10,000, 100.25 come interest, December 15, 2,500, 98.5 X interest. Come interest means cumulative of interest including interest. X interest means excluding interest. Debenture interest is payable half yearly, 30th of June, 31st of December. Show ledger accounts of debenture and debenture interest for the first year, ignoring income tax. Okay, I'll explain it to you. First, you please read the problem once more. Okay, now they said opening balance 500 debentures of 100 each. That's how you get 50,000. And on March 1st, you purchased 5,000 debentures. So face value first, 5,000 debentures of 100 each, 50,000. But how much you paid? 5,000 debentures of 98. But 98 includes interest, eliminate interest. How do you calculate interest? Interest to be calculated from the date of purchase, go back till the previous date of interest payment. Why previous date of interest payment? Because this interest refers to interest accrued till the date of transaction. What do you mean by interest accrued? The holder of the shares is eligible for receiving interest for month 1, month 2, month 3, month 4. Now, but my interest receivable after 6 months. Month 4, I am selling it to somebody. So for the first 4 months, I have the right to receive interest. So I will collect from that person to whom I am selling. So interest accrued refers to the interest for the holder from the date of interest payment till the date of transaction, interest accrued. So in this case, date of transaction is March 1st. But when was the interest paid? Debentures payable on June and December. So December would have been the interest payment. So January, February, 2 months interest accrued. So when you purchase debenture, you not only pay towards the debentures, you also pay towards the interest, because you have right to receive interest. You receive interest. So you pay for it now because you are not the holder for that period. 2 months, Jan, Feb. So 5,000 into 100, face value 100, interest 6% into 0.06. You get rupees 5,000. On 5,000 rupees, sorry, rupees only 5,000. 5,000 into face value 5,000 into 6%, 300. But only for 2 months, 300 into 2 by 12, 50. That's what they have done, 50. How did they calculate? Once more, 5,000 into 6% into 2 by 12. What is the 2? Jan, Feb. Why it is that? Date of transaction is March 1st. Interest accrued till the date of previous payment. From the date of previous payment till the date of transaction. Date of previous payment 31st December. Jan, Feb. March 1st transaction happening. Interest accrued for 2 months. 5,000 into 6% into 2 by 12. So in the whatever amount you get, 5,000 into 98, 5,000 into 98%, you get 4,900. 50 rupees you take it out for interest. Balance 4850 is the payment made. But what is the face value of these ones? 5,000 face value. How much you paid? 4850. Capital reserve 150. On cancellation, it's not capital reserve. It will be transferred to P&L 150. Why it's a profit, sir? 5,000 is the face value. See, the debenture is like a liability. 5,000 is the liability in your books. You paid 4850. 5,000 is the liability. You paid 4850. Don't you think it's a profit? You paid lesser amount, paying the creditors at a discount. 5,000 is liability. You paid 4850. 150 is like discount. Transferred to P&L account. And balancing figure 45,000. Okay, debenture interest payable, 50 rupees already paid. This 50 rupees. 50 rupees already paid. What is journal entry? 6% debenture 4850. Interest accrued 50 to bank 48,900. Correct? 4890. I repeat the entry once more. Focus. Debenture account 6% debenture account debit. What is the amount? X interest 4850. Debit interest accrued 50. 4850 plus 50. Total to bank 4900. So in the debentures account you write to bank 4850. In the debenture interest account you write again to bank 50. And the debenture interest payable, out of 50,000 we had, 5,000 cancelled. So 50,000 minus 5,000 you do 45,000 into 6% into 6 months, that is June 30th you make 1350. Net payment 1400 goes to P&L account. Clear? Okay, now second half debenture. Second half, by balance brought on 45,000 out of 50,000, 5,000 redemption already took place by way of purchase of own debentures. Balance is 45,000. Now next transaction, August 1st. What happened on August 1st? 10,000 at 100.25 come interest. Okay, 100.25 ignore for the time being. First you tell me how much interest accrued. 10,000 into 6% for what period? Interest payment till the date of transaction, that is interest accrued. Correct? Now how many months? December, don't take December. Next payment June over, June 30th. Then July, August 1st, 1 month. 1 month interest accrued from the date of interest payment till the date of transaction, June 30th till August 1st, 1 month. So 10,000 into 6% into 1 by 12. 10,000 into 6% into 1 by 12, 50 rupees. So 50 rupees goes to interest. But how much you pay total? 100.25. 10,000 is for 100. divided by 100 into 100.25. 10,025 you paid, but 50 rupees goes to the interest accrued. Balance 9975 is paid towards pure acquisition of debenture, towards cost of acquisition of debentures. That is nothing but your X interest. So 9975 would be the payment. You look at this second half, debentures accounts to bank 9975. How 9975? 10,000 minus 10,000 into 100.25 by 100. 10,000 by 100, that will give you 100 debentures into 100.25, that is 10,025. You paid 10,025, but includes 50 rupees. Come interest, includes 50 rupees interest. So 9975 is purely towards cost of investments. Face value of debenture was 10,000, liability to be settled, to be cancelled, but you paid only 9975 towards it. Balance 25 rupees, profit, not capital reserve, transfer to P&L account, cancellation of debenture 25. Now similarly, on December 15th you purchased X interest. 2,500 into 98.5. Here no need to subtract interest. X interest already excluding interest. This interest will be also paid. Journal entry will be investment account or debentures account debit, interest account debit to bank account. But because X interest, I need not subtract interest. It's already subtracted interest. So directly I can do 2,500 into 9 divided by 100. You get 25 debentures into 98.5. That itself is towards cost. Directly you can write 2,500 divided by 100, 25 debenture into 98.5, 2462.5. But what is the face value of debentures redeemed? You are purchasing and cancelling. Nothing but liability payment. What is liability? Face value 2,500 into 100 means 2,500. 2,500, 25 debenture into 100, 2,500. But 2462, balance 37.5 is like a discount on payment, transfer to P&L, not capital reserve, balance 32,500. Now, debenture interest accounts. First, you make a payment of 50 rupees on 10,000, 6% for 1 month. 10,000 into 6% into 1 by 12. That 50 will come. And the previous one, what we just discussed now, that is also X interest. So, interest we did not calculate. Still, you have to pay. It might be X interest. Still, you have to pay interest accrued. For how many months interest accrued? Please take a look at the date. December 15th from June 30th, July, August, September, October, November, December, 5 and 15 days, 5.5 months. December 31st was the due date. 16 days you take it, remaining 5.5 months. Okay, so 2,500 into 6%, 5.5 months, 5.5 by 12. 68.75. Number of days and all, don't worry, number of months is fine. So that's how I got 68.75. I repeat once more. From the date of interest payment till the date of transaction. Date of interest payment June 30th, date of interest, date of transaction, date of redemption or date of purchase of own debentures, that is 15 December, July, August, September, October, November, December. December means 6 months, but half only, so 5.5 months. So face value of 2,500, rate of interest 6%, number of months 5.5. You already made the payment 68.75. And how much debenture holders are there at the end of the year? 32,500. For 6 months you have to pay interest 32,500 into 6% into 6 by 12, 975. Net amount transferred to P&L account. So this is the way you treat redemption of debentures where own debenture is involved. So I hope you had some sort of confidence with respect to redemption of debentures. With respect to redemption of debenture reserve account, it's very simple. Debenture reserve investment account is there. Sell it for, suppose redemption reserve amount is 10,000, sold for 8,000, investment sold for 8,000, 2,000 loss, transfer to P&L. Reserve will be there, transfer to general reserve. Very simple. Profit or loss, transfer to P&L. Income from investment, debenture reserve investment, transfer to P&L. Profit on cancellation of debenture due to own debenture purchase, transfer to P&L. Once redemption is closed down, the balancing figure in debenture redemption reserve account transfer to general reserve, thereby stating it becomes free reserves. That's all. I hope you got some confidence. So this is the completion of the chapter Debentures Redemption. and preference shares redemptions. Fine? See you.